This is sales variances, the same topic, 14B3 to 14B6, 3, 4, 5, 6. 4 questions are there. A company manufactures a single product and extract from a variance control report together with relevant standard cost data as shown below. Let's read it. Standard selling price per unit, standard selling price. $70 standard direct material cost, 5 kilogram into $2 per kg, 10. Total material cost of sales, budgeted total material cost of sales, $2,300 per unit. Budgeted profit margin, 6,900. Actual results for February, sales revenue 15,200. Total direct material cost 2,400. Direct material price variance 800 adverse, price variance. Material usage variance 400 favorable. So total material variance is 400 adverse. You can make them together. There was no change in inventory levels during the month. What was the actual production in February? So you have to go back and think. It's like, starting from the end and going towards backward. So what is the actual production they told us? We know that our, budgeted data was given, and then they told you some results actual, and what is the actual production. So it should be very simple. What they did, that they told you that you have actual material cost. Actual material cost which you have incurred is 2,400. And then there are some variances. If the variance has not, so we will just take away the effect of, this variances, and we'll find out the standard. See, there are 3 things. One is called budgeted, one is called actual, and one is called standard. The difference between actual and standard is this, that how much it should be. This is your standard. This is how much it was, and this is your plan. This planned budget actually is not really very important for us. We only use it to find out our OAR. Anyways, we start with actual material cost 2,400, but then there are some material variances. You have material variances which are material, price variance, and you have material usage variance, and one of them is favorable and one of them is adverse. So adverse means minus 800. Minus 800. Why I'm saying minus 800? And why do I not call it plus? This is my standard cost, okay? Now I'll just only keep one variance here just to make you understand. So now I say that my cost should have been 1,600, but it was 2,400. That's why it is adverse variance. If I put a plus sign, then it is a favorable variance. Because your material price variance, it is adverse. You should put minus. And now it makes sense when I say that my cost should have been 1,600, but actually it was 2,400, and that is why it is an adverse variance. And this one will be 400. So your standard cost, so we do not know how much we produced, okay? We have to find out how much units we produced. So we say that whatever units we produce, let's suppose we produce X number of units. The cost should have been 2,000. I mean, whatever you produced, its cost should have been $2,000 in total. And now you can calculate your number of actual units produced, actual units. Because your budget, now this is your standard, and your budgeted material cost per unit was $10. So you say that if $10, I keep it in mind, if we consider that 2,000 divided by 10, So we say that we should have been spending $2,000 on producing 200 units. This is how much it should have been. So for 200 units, it should have been $2,000. So that's very simple. Answer should be 200. Next question is 14B4. What was the actual usage of direct material during February? How much was the actual usage? This 14B4 is very interesting and very simple. Very simple. Question they ask you that how much was actual material used? Okay. This is the question. Okay. How much material you used actually? So how can you find out? So I know that my actual production, how much is actual production? 200, right? And what is the quantity I use in one unit? If you see the question, they told you that in 1 unit you use 5 kilogram, and you already have calculated that you produce 200 kilograms. So it means that 200 multiplied by 5, my actual usage should have been 1000 kilogram. This is how much it should have been. I mean, based on 200 units actual production, and each unit is taking 5 kilogram, it should be 1000 kilogram. But it is not 1000 kilogram because there is some variance. Your variance is $400 and it is favorable. Favorable. It means that you used less material. Favorable means that you used less material. So we should say less favorable variance, okay? Favorable variance quantity. So it is $400. What is the price of, or what is the cost of 1 kilogram? Can you tell me what is the cost of 1 kilogram? $2. $2 per kilogram. So you are getting $400 divided by 2. So it means that 200 kilograms you used less. Actually, you used 200 kilograms less. 400 divided by 2. So your actual production is 800 kilogram actual usage. See, I speak it again. How did I calculate? They told us in the question that you produced 200 units. 200 units. And we know that 1 unit, it takes 5 kilograms. So it means that 200 units multiplied by 5 kilograms, 1000 kilograms should be your usage. But you used not 1000 kilogram because they told you that there is a favorable variance of $400. So this, if it is $400, how many kilograms were favorable? So I just multiply 400 divided by the cost per kilogram, $2. So I say that we consumed 200 kilograms less. Okay. When I say that it is favorable, it means that we are using less material. So therefore I subtract 200 from here and I say that actual material usage is 800 kilograms. Are we clear on this?
Yes, sir, got it.
Huh?
Yes, sir.
Okay. Now, next is 14.5. What was the selling price variance for February? Now, selling price variance is very simple. Very, very simple. 14B5. Selling price variance. Selling, not volume, but selling price variance. Always very simple. Start with the actual units sold. You say 200 units should sell for at whatever it is, at the rate of, what is the standard price, selling price? $70 at the rate of USD 70. This is how much you should be selling. 200 times 70. So your selling price should be 14,000. But then I say that 200 units actually were sold for, how much we sold for? Actual sales were 15,200. 15,200. So you are selling for more. When you are selling for more, it is favorable because you are getting more money. It is a favorable situation for you. And $1,200 favorable. And you should remember that this is dollar sign here. Okay. This is $1,200 favorable. Very simple. Start with the actual quantity. Like 200 units should sell for 14,000, but they did sell for 15,200. Then you have 14B6. This is also from the same question. And now you have to find out sales volume variance. Sales volume variance. So sales volume variance is always like, if you remember from the lecture, there is nothing as sales volume variance. You have sales volume profit margin variance, or you have sales volume contribution margin variance. So you should always think about, am I doing it sales volume profit margin or contribution margin? And we know that if we use absorption costing method, we are saying about sales volume profit margin variance. If you use a marginal costing, then you say sales volume contribution margin variance. So let's see that our budgeted sales and our actual sales in quantity, in numbers. What were the budgeted sales? It says budgeted total material cost. So 2,300, 2,300 budget profit margin. So I can say that we said that there is no change in inventory. It means all the material purchased will be used. So 2,300 divided by 10, you are actually producing 230 units. Your plan is 230 units. This was your budgeted sales, okay? How did I calculate? Because they told me that there is no opening closing inventory difference. Inventory will be same. It means that all the material which was purchased, it will be used. 2,300 is total cost of material, and each unit is taking $10. You divide them and you say 2,300 units. So our plan was producing budgeted sales was 230 units, but we produced only 200. So it means that we produced less. It is called adverse. So you sold less units, okay? You sold less units, 30 units, these are in units. And then you multiply it, this 30 units adverse, variance cannot be expressed in units, it must be in dollars. So what is the question? In question, they tell us how much is the profit or how much is the contribution. They told us budgeted profit margin. Profit is 6,900. But 6,900 is for how many units? You are assuming 6,900 for 230 units, because you said that I will produce 230 units, and from 230 I make 6,900 profit. So what is the profit per unit? 6,900 divided by 230. So this 0 is gone, and 23 is 30. So my profit margin from one unit is $30. Okay, so I just go back and $30. It is this here, and I put 30 here, and this I say, my standard profit per unit. So sales volume variance. 30 times 30. It is 900 adverse. 900 adverse is your sales volume variance. Sales volume profit margin variance. Then comes 14B9, sales price variance, sales volume variance. And you should remember volume variance means sales volume profit margin variance or contribution margin variance. It should be an easy question. We'll do it very quickly. First we do sales price variance. Okay, and then now we need to read the question. Let's read it. It says that the following data relates to one of a company's products. Selling price per unit 27, variable cost 12, fixed cost 9, your profit is 6, okay? 27 minus 12 minus 9, 21. Total cost is 21, profit is $6. Budgeted sales for control period were 2,400 units, but actual sales were 2,550. This number we will use for sales price variance. The revenue earned from these sales was 67,320. Profit reconciliation statement are drawn up using marginal costing principle. This is important, marginal costing principle. We will use sales volume, contribution margin variance. What sales variances would be included? Very simple. How many units you sold? You sold 2,550. You say 2,550 units should be sold for 2,550 multiplied by your standard price, which is 27. So I put it here. So this is what my sales should have been. But then I say 2,550 units were sold for, how much they actually were sold for? They actually were sold for 67,320. So the difference is 1,530. This is 1,530. Of course, it is in dollars. And you should be selling for 68. You sold them at a lower price. It is adverse. So you say that your sales price variance is 1,530 adverse. It's very simple. Then you have to calculate sales volume variance. Again, sales volume, and I would say sales volume contribution margin variance, because they say that the company uses marginal costing principle. And then you will say that how much were budgeted sales and how much were actual sales, okay? So your budgeted sales were 2,400, because it says budgeted sales for period 7 were 2,400. Actual sales were more. So what is the difference? Difference is 150 units. So this is in units. And because you are selling more, so I can call it favorable. So you have 150 units favorable. And you should multiply it with standard contribution margin, okay? I should be multiplying it with the standard contribution margin. How much is the contribution margin? Selling price 27, variable cost is 12.
Variable cost.
So 27 minus 12, and it is 27 minus 12. Contribution is 15. And then I just multiply this with this and 2250. And this 2250 is actually favorable. So now you have got two options, two answers. You say price variance is 1,530 adverse and volume variance is 2250 favorable. 1,530 adverse, 2250 favorable. Answer option should be B. This should be our answer. Very simple question, but very typical question in exam. Then we move down to next is 14B10. Okay, it is the same sales volume profit variance, okay? You can calculate yourself, find out sales volume, how much are the budgeted sales, how much were the actual sales, the difference, multiply with the profit. Then comes 14B17. This question we need to do. 14B17. Let me read it for you. It says AD company manufactures and sells a single product, E, and uses a standard absorption costing system, absorption costing. Standard cost and selling price details for product E are as follows: standard cost and selling price. So variable cost 8, fixed cost 2, total cost 10, profit 5, selling price 15. Okay. The sales volume variance reported for the last period was $9,000 adverse. So we are going to use this information. They tell you that you have sales volume variance, which means, and it is adverse, which means that you sold less units. AD company is considering using standard marginal costing as the basis for variance reporting in future. What would be the correct sales volume variance to be shown in a marginal costing operating statement for the last period? So this is what you have calculated sales volume variance. This is based on absorption costing. And they ask us that if we have to report it on marginal costing, how much it would be. We know that sales volume means, the budgeted sales and actual sale difference multiplied by the profit margin. How much was profit? 5. And what we need to do, we need to produce it based on the marginal costing, which means the difference in the quantity multiplied with the contribution margin we have to do. Okay, this is very, very, very simple question. I'll do it with 2 methods, okay? I'll show it with 2 methods. We know that our sales volume variance will be equal to, your difference in budgeted and actual sales multiplied by profit or contribution, one of these, depending on what you are doing. Now I know that my sales volume variance is 9,000. This they have given us in question. And difference in budgeted and actual sales we do not know. Let's suppose it is X. And then multiply it with the profit. In our case, we will multiply with profit because it is absorption costing and profit is 5. So then we can say that X is equal to 9,000 divided by 5. And which means that X is equal to 9,000 divided by 5. So what is this now 1800? This 1800, 1800, it actually is the difference between the budgeted sales and the actual sales. So this is what we did with the available information. Now if we have to do, if we need to calculate, sales volume contribution margin variance, because they tell us, listen, sales volume profit margin is already given in the question. They say how much it should be on contribution margin. So then I would say again, I will take the same formula and then I will say difference in sales is 1,800 multiplied by the contribution margin. That's all. How much is contribution? Contribution, you know, that is profit plus fixed cost. Contribution should be 7. So your sales volume variance should be sales volume contribution margin variance should be 12,600. And that 12,600 should also be adverse. Both are adverse because you are selling 1,800 units less. Now this is a little bit long way of doing it. It's a little bit long way of doing it. If you want to do it in a short way, this 9,000 actually, when I divide it with 5, it will give me, the number of units. What does this tell you? If I say 9,000 divided by 5, it clearly tells you the number of units. And then number of units, you must multiply with the contribution. You multiply it with 7. You get answer like this in calculator. I mean, if I'm in exam, I will do it like this, very straight. 9,000 divided by 5 multiplied by 7. Please pay attention. When I say 9,000 divided by 5, what it will give you? 9,000 divided by 5, this expression, it will give you an answer, which is the number of units, like 1,800. And then what you should do, you should multiply this number of units with the contribution. and you just multiply simply with contribution 7. So I just explained you with this way, like the logic, but if you are in exam, it should be done like this. One simple step, you are done.